Building a home is more than just a construction project. It's the realization of a dream. It's about crafting a space that reflects your style, meets your family's needs, and stands as a testament to your aspirations. But before the foundation is laid and the walls go up, there's a crucial step: securing the right financing. This is where construction loans come into play. Unlike traditional mortgages for existing homes, construction loans are designed specifically for new builds, covering the costs of land purchase, architectural plans, permits, materials, and labor. These loans provide a financial lifeline, enabling you to turn your vision into a tangible reality. However, navigating the world of construction loans can feel like navigating a complex maze. With different types of loans, varying terms and conditions, and a myriad of factors to consider, it's easy to feel overwhelmed. That's why we're here to guide you through the intricacies of construction financing, equipping you with the knowledge and confidence to make informed decisions. Whether you're a seasoned homeowner or a first-time builder, understanding the ins and outs of construction loans is essential for a smooth and successful building experience. Today, I have two of our construction loan experts, Mark and Steve, to go over some frequently asked questions regarding construction loans. Construction loans come in various shapes and sizes, each with its own set of advantages and considerations. One of the first decisions you'll face is choosing between a one-time close and two-time close construction loan. Mark, can you address this important question?
This choice depends on your financial situation, risk tolerance, and long-term plans. One-time close loans, as the name suggests, involve a single closing for both the land purchase, construction phase, and the permanent mortgage. This simplifies the process, requiring only one application, one set of closing costs, and one loan to manage. On the other hand, two-time close loans involve up to 3 separate closings, one for the land, one for the construction loan, and another for the permanent mortgage once construction is complete. Appraisals are needed for each loan, as well as going through underwriting each time. Each option comes with its own set of pros and cons. One-time close loans offer convenience and potentially lower overall closing costs, while two-time close loans provide more flexibility during the construction phase and after construction. Understanding the nuances of each loan type is crucial for determining which option aligns best with your financial goals and building timeline.
Steve, can you help borrowers grasp the key differences between one-time close and two-time close loans?
Let's take a quick look at their respective advantages and disadvantages. One-time close loans, pros. One closing, potentially lower closing costs. At the end of construction, you get a free float down in rates to the current market rate. Cons: higher interest rates during construction, less flexibility for changes during construction. Two-time close loans. Pros: potentially lower interest rates on the permanent mortgage, more flexibility for changes during construction. Cons: 2 closings, higher overall closing costs. Interest rate on the permanent mortgage is not locked in until the second closing, and you must get 2 appraisals and go through underwriting twice, and if something goes wrong, you could be denied on the second close, leaving you scrambling to pay off the entire construction loan in a short time frame to avoid a potential foreclosure. By understanding these fundamental differences, you can begin to narrow down your options and focus on the loan type that best suits your needs and circumstances. Remember, knowledge is power, and the more you understand about construction loans, the better equipped you'll be to make informed decisions that support your dream of building a new home.
One-time close construction loans simplify the financing process by consolidating everything into a single closing. Mark?
You only deal with loan applications, closing costs, and mortgage payments once. Enjoy a lower market rate when the home is finished at no cost to you. This provides predictable payments and peace of mind. Funds are dispersed in stages, accruing interest only on the disbursed amount. Once construction is complete, the loan converts, or is modified as it is called, to a permanent mortgage.
Down payment and credit score requirements. Steve?
One-time close construction loans require a 0 to a small down payment, typically $0 to 5%. Click on the link in the description for more detail on our available programs. Your credit score is crucial for loan eligibility and interest rates. Aim for a credit score of 680 or higher. Although some programs have lower score requirements, Click the link in description of the video for our current requirements for each program. Review your credit report and address inaccuracies before applying. A strong credit history increases your chances of loan approval. Understand the importance of a healthy down payment and good credit score. Be prepared to secure a one-time close construction loan and turn your dream home into a reality. To discuss your situation and schedule an appointment with one of our construction loan experts by calling 888-857-8041 or clicking the link in the description below.
Potential penalties and choosing the right loan. Mark, can you cover this one?
Sure, Sarah. One-time close construction loans offer convenience but may have significant penalties for early payoff. Two-time close loans often have no prepayment penalties, offering more flexibility. Choose based on your financial goals and risk tolerance. Consult construction loan experts to find the best option for you. To schedule an appointment, call 888-857-8041 or click the link below in the description. Exploring two-time close construction loans. Two-time close construction loans divide the process into two phases: construction and permanent mortgage. This offers flexibility and control over loan terms and costs. The first closing funds land in construction while the second secures the permanent mortgage. If you're going to hang on to your current home and plan to sell just before your new home is finished, this can give you long-term savings and avoid the significant prepay penalties for the early payoff of a one-time close construction loan. Advantages and disadvantages, a balanced view. Two-time close construction loans have both advantages and disadvantages. Advantages: increased flexibility during construction. Disadvantages involve the need for two closings, two appraisals, and twice through underwriting, added costs, and other unknown risks. Understanding these factors is crucial for making informed decisions. To see which is best for you, call 888-857-8041 and set an appointment to speak with one of our construction loan experts, or click the link below in the description. When does a two-time close loan shine? Two-time close construction loans shine in specific scenarios where their unique advantages outweigh potential drawbacks. They offer flexibility for anticipated financial changes and limited down payment funds. If you value flexibility and control, a two-time close loan grants greater autonomy.
Navigating eligibility and co-borrowing. Steve?
Thanks, Sarah. Securing a construction loan involves meeting specific eligibility criteria set by lenders. We assess your creditworthiness, ability to repay, and overall risk based on the program criteria set by each agency: Fannie Mae, FHA, and the VA. Understanding these requirements is crucial for a smooth loan application. A strong credit score, typically 680 or higher, increases your likelihood of approval. Lenders also review your debt-to-income ratio, or DTI. A lower DTI indicates a greater capacity to manage additional debt. We evaluate your employment history and income stability. A steady job with a consistent income stream reassures the underwriter and the lending agencies. Co-borrowing can strengthen your loan application. A co-borrower combines their financial resources and credit history with yours. The borrower with the lowest median score is the score that the underwriter and agencies use to assess the risk. Both borrowers are equally responsible for repaying the loan. There are specific requirements for co-borrowers, and for more information on that, click the link in the description below.
Leveraging owned land can reduce upfront costs and enhance eligibility for a construction loan. Steve?
Yes, using land that you already own as collateral and you have equity above what you may owe on the land can lead to better loan terms, easier underwriting, and interest rates. The appraiser assesses the land's value and consider remaining equity as your contribution. Disclose family relationships to ensure compliance and smooth loan approval.
Construction loans, like traditional mortgages, are subject to loan limits that vary based on factors such as loan type, geographical location, and the type of dwelling. Mark, what can you tell our viewers about that?
These limits, set by government-sponsored enterprises like Fannie Mae, Freddie Mac, FHA, and VA, dictate the maximum amount you can borrow that the agency will guarantee. For conventional loans, Loan limits tend to be higher than FHA government-backed loans, such as FHA have lower loan limits but more lenient eligibility requirements. Before applying for a construction loan, call us at 888-857-8041 or click the link below in the description to schedule an appointment to speak with one of our construction loan experts. This knowledge will help you determine if your project's financing needs fall within the acceptable range. While construction loans primarily cater to individuals building their primary residences, investment properties typically fall under a different lending umbrella and are considered commercial in nature, and you would need to seek out a commercial construction loan from a commercial bank. This is because investment properties are significantly riskier than owner-occupied homes with much higher default rates. If you're considering building a property for investment purposes, explore commercial construction loans or portfolio loans designed for real estate investors. These loan products often have different terms, interest rates, significant down payment requirements, and underwriting criteria tailored to the unique risks of investment properties.
Embarking on a new construction project involves assembling a team of experienced professionals, with your builder playing a pivotal role. We require builders to undergo an approval process to mitigate risk. This safeguards both our investment and your dream home. Criteria include builder's experience, financial stability, and insurance coverage. A proven track record inspires confidence in project completion. We review portfolios for quality and adherence to timelines. The approval process ensures a successful construction journey. As you navigate securing a construction loan, you'll encounter various services crucial for a smooth closing process. Steve?
One such service is title insurance, which protects you and us, the lender, from any unforeseen claims regarding the property's ownership history. A title company conducts a thorough examination of public records to trace the chain of ownership. They issue a title insurance policy that provides financial protection against any covered losses arising from title issues discovered after closing. While builders often have preferred title companies, borrowers typically have the right to choose their own title company. This flexibility allows you to select a provider you trust, compare fees and services, and ensure you're comfortable with their title insurance policy. When selecting a title company, consider factors such as their reputation, experience, and customer service. Don't hesitate to ask for recommendations from your builder, online ratings, or trusted friends and family. Choosing your own title company can provide peace of mind, knowing that an independent third party is protecting your investment. It allows you to take an active role in ensuring a smooth and secure closing process.
Life is full of unexpected twists and turns, and sometimes circumstances change after you've secured a construction loan. Mark?
Whether it's an unforeseen expense, a job change, or a shift in financial goals, on most government-guaranteed one-time close construction loans, such as FHA and VA, there is no look back after you close on the loan before beginning construction, as long as your builder finishes within the 12 months that the agency gives the builder. That means no credit check, no employment check, no underwriting for a second time. For conventional, there is a recertification, so the credit is pulled and it is verified that you are still employed. While it is not a full underwrite, the underwriter is checking you are still good for the permanent loan. For two-time close loans, as the name suggests, everything is checked again as it was for the initial construction loan. So if you have had some credit blemishes show up, or a job loss or reduction in income, then you may have issues getting the construction refinance loan, known as a takeout loan, leaving you in a bind to pay off the construction loan to avoid penalties and additional interest payments. Open and honest communication with your construction loan expert is crucial throughout the process.
An appraisal assesses the fair market value of your soon-to-be-built home.
This valuation determines the loan amount that we and the agency would approve. If the appraisal is lower than expected, it can create a financing gap. Agencies will finance based on the lesser of the appraised value of the acquisition cost of land, home build, and, if applicable, construction interest. Options include cost reductions or contributing additional funds. Open communication ensures a smooth outcome.
Building a new home is an intricate process, often involving a multitude of decisions and potential changes.
As construction progresses, unforeseen circumstances might lead to the need for modifications, impacting the overall project cost. Change orders, which document agreed-upon modifications to the original construction plans, can arise from various factors. Unforeseen site conditions or design upgrades can contribute to increased costs. While we and the agencies understand that modifications happen, requesting a loan amount increase after closing can be complex if it is even possible. We and the agencies typically have stringent guidelines for approving such requests. That is why, on the initial pre-qualification, we pre-qualify you for the maximum loan available. The agencies will likely require a thorough justification for the loan amount increase. If you didn't qualify for the larger amount at the original close, most probably you would not qualify for the loan increase. The information requested will include detailed documentation of the change orders and an updated construction budget. A new appraisal will be to ensure the requested increase aligns with the property's enhanced value. Loan amount increase requests are not guaranteed approval, and agencies may have limitations on the percentage or dollar amount they're willing to increase. In some cases, borrowers might need to pay for the additional expense out of pocket.
Construction loans often come with specific terms and conditions that outline the lender's expectations and the borrower's obligations. Steve?
Penalties, which are financial consequences for violating these terms, aim to protect the lender's investment. One common type of penalty is the prepayment penalty, which applies if you decide to pay off your one-time close loan before the agreed-upon term. Agencies factor in the interest earned over the loan's life when structuring the loan terms. Prepayment penalties can vary significantly depending on the agency and loan type, ranging from 10 to 20% of the loan amount. Another type of penalty might apply if the construction project experiences significant delays. Construction delays can disrupt the builder's disbursement schedule and increase the overall risk. Agencies many times impose penalties for exceeding the construction timeline, usually 12 months. Understanding the specific penalties outlined in your loan documents is crucial for making informed financial decisions. If you anticipate the possibility of prepayment or foresee potential construction delays, discuss these scenarios with your construction loan expert upfront. This helps you understand the potential financial implications and explore strategies to mitigate any associated penalties.
Building a home is an exciting endeavor filled with the promise of personalized living spaces and lasting memories. Securing the right construction loan is paramount to turning this dream into a reality. By understanding the nuances of one-time close and two-time close loans, you've equipped yourself with the knowledge to approach this financial journey with confidence. Knowledge is power, and the more you understand about construction financing, the better prepared you'll be to make informed decisions. Whether you prefer a one-time close loan or a two-time close option, consider the advantages and disadvantages of each. Don't hesitate to ask questions and seek clarification on any aspect of the loan process. Call us today at 888-857-8041 or click the link below in the description to make an appointment with a construction loan expert. Building a home is a significant investment, both financially and emotionally. Having a trusted team by your side can make all the difference in ensuring a smooth and successful outcome. Navigating the world of construction loans can feel like entering uncharted territory, but you don't have to embark on this journey alone. Our experienced construction loan experts can serve as invaluable guides, providing personalized advice and helping you make informed decisions. From pre-approval to closing and beyond, a knowledgeable mortgage professional will be by your side. We'll work diligently to secure the most competitive interest rates and loan terms available. Beyond the technical aspects of financing, a skilled mortgage professional understands the emotional investment involved in building a home. They'll provide empathetic support, patiently guiding you through any challenges that may arise. Remember, your construction loan expert can help you in choosing the right loan product. We will prioritize your best interests, and we have a deep understanding of construction financing. A proven track record of helping clients achieve their homeownership dreams is essential. Just check out our testimonials listed on our website at the links below. Your dream, our priority, partnering for success. Building a home is about creating a foundation for your future, where memories are made and dreams take flight. We're your trusted partner in construction financing. Our experienced team provides personalized guidance and competitive loan products. We empower you with knowledge to navigate construction financing confidently. Contact us today at 888-857-8041 or click the link below in the description to start your home building journey. Together, let's turn your vision into a place you'll be proud to call home.